Hello, my name is Andrew Dix, and I'm the founder of the Crowded Media Group. We're the publishers of Crowdfund Insider. And today we are having a discussion with three experts on impact investing. This is a sector of finance that has grown dramatically in recent years. In fact, in 2022, it was estimated that impact investing stood at around $420 billion. And this amount is expected to grow by double that number by 2026. So clearly, there is interest and there's demand out in the market. So we have three people from three different platforms that are going to share their perspectives today. And I'm going to ask each of our panelists to introduce themselves briefly. And I'm going to start with you, Sherry.
Thank you so much. My name is Sherry Noonan. I'm the CEO and co-founder of Rialto Markets. Rialto Markets is a FINRA member broker-dealer, and we also operate an alternative trading system across all private markets. Our focus is really empowering companies, issuers, as well as other marketplaces in their ability to offer primary issuance and secondary trading. And we do have several ESG companies utilizing both our primary markets as well as our platform solution.
Awesome. Thank you very much, Sherry. Bruce.
Yep. Thanks. Bruce Davis from Abundance Investment, based in the UK. We are an investment crowdfunding company. I've been going for the last 10 years, focused almost entirely on helping small investors invest directly into green infrastructure and green companies specifically. Started off in the wind and solar energy space, but now sort of branched out into a number of different sectors as the economy moves towards an alignment with the targets around net zero and so on that we've set in the UK.
Awesome. Thank you very much, Bruce. Paul, tell me about you and Justly.
Yes, thank you, Andrew. Paul Carlson Willis. I'm the CEO of Justly Markets. We are also a US broker-dealer licensed to do private equities, so everything from CF, Reg A, and Reg D. We do have an investment banking group. We also trade in the secondary market, again, around private equity. We are an impact broker-dealer, and what we mean by that is most of the deals that we have on our platform make an impact in some form, be it environmental or social. We as a company are also going through our B Corp license, so we can be actually classified as an ESG company ourselves in the way we run. And we've also committed to give 10% of our net profits to nonprofits. So again, making sure that whoever invests via Justly will be making an impact in one way or another.
Thank you very much, Paul. So impact investing is very much an emerging sector of capital markets. And for investors, there are both private and public opportunities to participate in this sector of finance. In brief, this means investors can support or back firms or issuers that align with your values. Now, frequently we talk about green investments, and Bruce is going to share a little bit about that with us. But there's also other subsectors of impact. Sometimes this is aligned with ESG, which is environmental, social, and governance, which there's been much discussion of in the US recently. But today we're fortunate to have three people that are participating in the private markets. And I personally believe that this creates a more interesting opportunity for smaller investors because you can get in early or access interesting securities if this is an area or segment that you're interested in participating in. So I'm first going to start with Bruce. I want to ask Bruce a question. But before I venture down that path, I want to mention that Bruce is really an OG within the online capital formation industry or securities crowdfunding. He predates me, and he is one of the founders of the UK CFA. And so he really, really knows his stuff. And so we're very fortunate to have him here. At the same time, Abundance, as far as I know, is the first platform anywhere in the world to offer impact securities to a retail audience. Now, you don't have to correct me if I'm wrong there, Bruce, but from as far as I know, you guys are number one and first. So How did you start by getting into this sector? What motivated you to go down this path? Was it just something that you had an interest in? Was it, just because you had this drive to support social issues, or was it a combination of return and benefit? Tell me.
Well, the motivation, I suppose, it comes from, we have 3 founders of Abundance, and we all came in it from slightly different angles. And I suppose the main sort of passion driver actually was the founder, Carl Harder. He had always had had founded an impact business, a sustainable cleaning business, and sort of lived through that, and then did an MBA. And in that process was sort of trying to come up with what he saw as an opportunity to develop exactly what you described, the ability for an ordinary person to make an impact investment. At that point in the UK, talking about here, regulation pretty much excluded anyone with less than maybe £5,000 to invest to participate. And so we set the goal, the essay question, if you like, was, can we allow an investor with £5 to participate? And therefore, I suppose the driver there, and this is probably where my main driver comes as someone who's worked a lot in crowdfunding, to try and democratize the process, democratize the access to these sorts of investments. It had become very much something of almost a clique or an elite of group, but actually what we could see was these were attractive investments, and it was largely a combination of industry and regulatory inertia that meant these weren't available more broadly. So that was a sort of motivation, opening up this asset class to say, we could see that people wanted to invest in this way. I'd spent a long time as an anthropologist studying people and their money and trying to understand this relationship between money and our values. And I think on the other side, yes, feeling that if we didn't do something, then it needed a catalyst. The market needed someone to show it could be done. And I think, that's been Abundance's role in a lot of the ways. We've broken the ground, which can be good and bad in terms of the experiences you have. But it's always, we've always tried to stay relevant and ahead of the market in terms of what we can offer, but also to coming back to what the types of companies that are looking to raise money move with the market. So I think where we started, we're very much talking about community businesses, place-based investing. Now we're talking about much larger companies and much larger infrastructure investments that are being made, particularly as things like electric vehicle charging takes off, the food industry wakes up to net zero, and I think more broadly within the sort of the energy space, the sort of the alternative renewable energies are starting to emerge as well. So it's sort of, it's been quite a journey, but the core motivation, I think, is we wanted to open up what we would call then green investments to that broader market.
Great. Thank you, Bruce. Paul, you run kind of a pure play impact platform. How did you decide to launch this? What were you doing before? Please, explain the genesis of launching Justly.
Yeah, so basically, I've been in the financial services business now for a good 40 years. And I'm only 25, believe it or not. I've, on the side of that, I've done a lot of stuff working with Special Olympics, the Flutie Foundation, National Down Syndrome. And that's really been my passion, so to speak. So in August of 21, Ideanomics, who own Justly Markets, listed on NASDAQ, are an EV company. And they decided to open a broker-dealer focused on impact. They have a lot of clients, so a lot of companies coming to them, looking for them to invest. They felt that having a broker-dealer that focused on impact and EV especially would be useful. So they approached me about setting up the broker-dealer. I love the idea on the EV side, but one of the things that I made sure that we did for me to come on board was to look more into the social element as well. So minority businesses, people with disabilities, trying to get them jobs, support those companies, raise money. So it's really kind of everything coming together for me in the sense of what my personal passions were coming together with what I have been doing for the whole of my career.
Interesting. So Sherry, you're a little bit different because you're a full stack broker dealer offering all exempt securities, primary issuance, secondary, kind of everything in a way. Impact is kind of a vertical. Let's start with how you got into launching Rialto Markets, because I know that's an interesting story.
Sure, absolutely. So my background's really in electronic trading. So the team and I built a lot of the electronic trading infrastructure in the US, and that was from the 90s until really 2015. And in 2015, we really were looking for another area of the market that was fairly greenfield, and private markets certainly were that. They'd grown quite substantially over the, from 2000 to 2020, 2021. And really, there wasn't a lot of technical infrastructure. There was a lot of legal infrastructure, but not technical. So we saw that. We saw the Jobs Act as a really interesting market structure change, as well as just people in general really looking to take control of their financial futures and wanting to support companies and investing with their feet and aligning with their values. And so we really felt that giving issuers the ability to empower them to be able to run a crowdfunding raise while we handled the regulatory, the technical, the operational aspects of that, harnessing that community that was galvanized around the company was a really good way to enter.
Okay, and you were on Wall Street, weren't you? You were on Wall Street for many years.
Yep. So I started at Instinet, which was an electronic trading company. I went from there to Goldman. They actually purchased a firm that I helped integrate into their platform. And then I went to Deutsche Bank as the COO for global electronic trading, became the COO of a couple of other divisions, equity derivatives and global equity trading. So a lot of, traditional capital markets experience.
Interesting. Yeah. So you're doing the full stack of securities offerings. Recently, Rialto announced an interesting deal with Rubicon, I think it was. Mm-hmm. And maybe you can share with us how that deal came about, what exactly Rialto does, and what the offering is. And I think it's more institutional focused, but I also believe that you're hoping to bring it out to retail at some point in the future.
So yes, so our specifically as it relates to Rubicon Carbon. So Rubicon Carbon's a really interesting example. They are a portfolio company of TPG. The TPG Rise Fund has funded their growth, and they're a really interesting and excellent example of what's happening in private markets, how new products are getting created and new distribution networks are being availed or being able to be marketed to. So what we work with Rubicon Carbon, and we're really the technology and broker dealer provider, as well as operational support for them. So if you think about, they have a product they've created, they've got their client base. We kind of do everything else. We handle the technology, the operations, and the regulatory construct or framework. And a lot more companies are interested in this, especially if you are creating like a marketplace. So specifically what Rubicon Carbon does is they have carbon-based offsets that they offer out to institutional clients, usually Fortune 100, but there are a number of others, and there has been talk to bring that down to even further. We are not Rubicon Carbon. We're simply providing them with the technology. So in terms of their strategy, I don't know exactly where that's going, but it certainly is a really interesting product coming to the market during a lot of very interesting interesting time in the market where companies are talking about net zero. How can they achieve their net zero goals? And this helps them with that. So we had to redesign our onboarding to be institutional in nature, And so we did that, as well as being able to accommodate some other things that were specific to their workflow.
So this is a bigger ticket item, and these are purchasing or trading carbon credits?
These are carbon-based offsets that are portfolios. So they're a portfolio of individual projects that can be purchased by a chief sustainability officer at a large corporation or by a company to help offset their goals in terms of being able to offset those carbon emissions that the company is producing. So we manage that entire flow, both the primary issuance, so the initial purchase of that portfolio, as well as then when those are retired. So the retirement of those carbon-based offsets.
So what exactly would be held in this portfolio?
Different carbon-based offset projects, right? So, and again, I don't work for Rubicon Carbon. But it is a portfolio of whether it's nature-based, emissions or other types of projects that are contributing to the carbon-based offsetting that carbon that's being generated by a company. So whereas a chief sustainability officer might go and purchase these projects one by one, what Rubicon Carbon is doing is creating a portfolio of them, and then they've got some interesting benefits around being able to handle some of the validation and other issues that currently go on in this space.
Okay. All right. So most of what I see in the market today, and I realize this is a broad space, are green projects. And I'm going to jump back to Bruce here, because that's kind of your foundation of abundance is green. Can you share, you touched on this for a minute, your initial products that you were selling as securities and what you're doing today, kind of share that evolution with us right now?
Sure. So, we started out, focused on, or trying to answer this problem. How can we come up with an appropriate product? And to be clear, from our perspective, we have almost no institutional investors. The institutional investors we have act like retail. So what is a sort of appropriate product for a small investor to get involved with? And the first one that we developed, thinking about the funding requirements, sort of project finance requirements of building a wind turbine or a solar park, was something called a debenture or a bond, be known as, but we use them as debentures. And we chose that for two reasons. One, it's finite in terms of its life. So you have a sort of fixed period where you as an investor will be involved in the project and its impact. And then being debt, it will be repaid, hopefully, at the end of that period, or it's repaid over its life. So that contrasts with, at the same time, there were a lot of people looking at equity models for that type of sort of community ownership of renewable energy. And they have different strengths and weaknesses. So on the debenture side, it's a regulated security. The way in the UK that we do the sort of equity investment tends to be through cooperative structures. So these are unregulated investment vehicles. And at that point, when we launched, the equity crowdfunding world was very much focused around startups and tech, not so much on green, though that has changed. And then I think what we took with those debentures, those are very effective for the type of investments that were available, which were quite long term, up to 20 years, backed by usually some element of a government support or subsidy on the price of energy that those producers generated. So there are a good balance of risk and reward there for investors. And we thought, as I said, this was an attractive asset class that previously you could only really access if you were in an investment club. So we kind of opened that up. And then I think as those sort of tariffs and subsidies fell away, we then sort of moved into backing, more, I would say, venture debt type approach. So this is higher risk. And we had to think carefully there about, well, how do we help people understand that risk? And from Abundance's perspective, our role is to carry out a level of due diligence on the offer from the issuer, but ultimately, we're there as the regulated firm, assessing and verifying where possible the details of that offer for our investors, but we're not producing that offer for them. We're not like an investment bank sort of standing in front of the issuer. We are a marketplace, more like a stock exchange ultimately. And it was then about coming up with a model that had the sort of a proportionate level of regulation for the size of deals. So when we started out, we were doing sort of £1 to £3 million kind of level. Then we moved up to sort of 5 to 7 million. 7 million is the current cap that we have in the UK, although that might change. And so we developed that model alongside, at the same time, as you'll be aware, the sort of development of peer-to-peer lending was coming through. People like Funding Circle, who are the big peer-to-peer lender, were doing £50,000 loans to small businesses, whereas we were doing 1 to 5 million to sort of larger scale green businesses. So I think at that point, very much debt finance. I think what's happened to the market now is it's kind of diversified a bit. We still focus on the debt finance side, but you're seeing a lot more of the big crowdfunding platforms now becoming some of the biggest kind of deal flow on clean tech in the UK on the equity side. And we're finding now that we might be funding the debt and say Crowdcube and Seed is funding the equity on different businesses. So investors are now got a lot more choice actually out there as to what they do. And in that process, we work with the government to sort of develop a new type of individual savings accounts. This is a tax-free wrapper for savings and also a pension product. So again, thinking about retail investors there, that's focused on retail. And then the last bit, which is just most recent in the last sort of 3 years, we've developed a new form of product, which is lower risk. So as we're sort of developing now into sort of a transition of the economy, we've definitely moved up the risk curve in terms of the type of debt that we're offering. So what we've now been working with is local councils, local authorities, to offer municipal debt, municipal bonds, which are sort of almost similar to the US municipal bond market, except it's not states issuing it, it's local councils, local towns and cities. And those have been very, very popular. We've done 7 of those, but there you're getting a return which is an impact return, i.e. there's a project on the other side, but the risk is very different. It's risk that's a little bit like investing in, say, UK government debt. So there we're
very low risk, no risk basically.
Very low risk, yeah. So we're talking a premium to gilt, but it is still for example, as a local authority, it's illegal to default. Now, it doesn't mean they don't not pay, but they can't default on their debt. So this is
there's some nuance there.
There is some nuance, but there is a law. So and for us, that was sort of going back to what I said earlier about sort of democratic finance piece. For us, it was saying, you know, impact investing, when you're talking about the kind of scale we operate at, it's about the stories, it's about the things that happen and people kind of realizing and connecting their money to real stuff. Okay. I think what's the driver of impact? It's a sort of waking up that money doesn't just sit there passively earning a return. It does something in the real world. And I think this is really what's driving that big number you're kind of describing around ESG, is this sort of wave of realization that what you felt was a quite sort of, you know, neutral and passive amount of money in, say, a pension pot or in a savings account is actually very much linked to the real economy in some way. And so if you're thinking about impact, whether that's green or social or however you want to describe it, you're kind of opening the box and saying, look, these things are connected. You know, you might think of money as something separate and private, but actually it's something very public and real. And that very public, real thing, you know, we think more people should be making more of the decisions around that. And arguably at the moment, we're in a sort of strange state where we kind of trust maybe, you know, essentially 20 fund managers to run half the wealth of the world. And that feels quite a concentration of personnel to me in terms of any kind of democratic process. And I think what we're just trying to represent within the impact investing space is to say that, okay, yeah, you can have experts in ESG, you can have guys who really do the due diligence on these funds and the companies that sit within them. But there's also stuff that happens in your community and stuff that happens in the real world. And I think, you know, for me, the crowdfunding element has always been about connecting your money into that real world. And when you do that, it becomes political. It becomes about values by default. And I think this is the bit where it's a really interesting catalyst at the moment, where, you know, discussing before we came on, you know, that regulators saying they don't regulate the climate. I mean, who regulates the climate? States, we do. Okay, we impact the climate, so our money also impacts it. So I don't buy the answer that regulators shouldn't care about climate. I think that for me is saying, well, look, that's the world view where somehow money is separate from what it does. And if we regulate money as separate from what it does, I think we run into the sort of problems that we saw in 2008.
Okay, we're going to go over to you, Paul, and I want to stick on the green theme because it's a big sector of impact right now. As a platform, I was on your site the other day. You have multiple offerings listed. Not all of them are effectively climate, but what type of climate related securities are you, or is Justly offering today for investors?
So right now we have a great company actually out of the UK called Serify, and they're focused on geothermal energy. So the person who founded this was actually on the other side of the fence and comes from the oil industry. And they have found a way of actually using old oil wells and actually repurposing them to produce geothermal energy. Now, when we talk about energy solutions, you always hear about wind, solar, but when you look at geothermal energy, it's been around forever. Right, this is something that Iceland, if anyone's ever been to that wonderful country, most of their energy comes from geothermal. So this isn't something that's new, but the way they are able to produce it is. And again, it's what we like about it, apart from it being a energy solution, what it also does is, as I say, it uses wells that are no longer being used. And therefore, by opening them wells up again and bringing that geothermal energy in, they're now bringing jobs back to areas that jobs were lost. And now you've got social impact. So, we talk about green impact. We can talk about companies like In Green, for instance, that we work with out of Canada, great building material company. They're looking to open a factory in the US. Their product enables them to build houses quicker, more efficiently for the environment.
Is this a modular housing type company?
Yeah, it's how they fit together. They fit together a lot more quick. So yes, it's like Lego blocks. But they can be used in various different sizes. So it's not, okay, everything looks the same. You can actually build a $3.8 million home using their technology. And it's stronger. So again, the plus point with that, apart from being very much the E, they're bringing jobs in because they want to build a factory. They're bringing jobs in. So again, you're looking at social. We have another great company, a little seedling called Hug Cycles. And this is a veteran-owned business where he started building his own EV motorcycle. So these are ones that you can drive without actually having a driver's license. And so he started building them, got a demand for them, brought in more veterans to help him build them. And now he's producing, or Hug Cycles are now producing these wonderful EV cycles. But again, it hits the social element because he's veteran owned, he's minority owned, he's given veterans jobs. So a lot of people go, oh, is it E, is it S, is it G? You know what? It's definitely E and S every single time because these are new industries coming in, enabling people to get jobs. So they're not separate. And it goes very much to what Bruce said. You can't look at people spending money and it only being one way to look at it. And so when people are investing, they need to be aware of the impact they're making. And again, investing in something like Hug Cycles, you're making a difference because it's EV, so you're doing the E, and you're getting people, veterans and jobs that is a sector of the community that find it hard to get jobs, which shouldn't be the case, but they do. So you're now making an impact twofold. And I think that's one of the reasons that you're seeing over here in the US, and I'm not sure what it's like in the UK, but you're seeing people that used to donate a lot to nonprofits actually moving some of that now into companies and having direct impact into companies like Hug Cycles. They believe in supporting the veterans. What's a better way of doing it than investing directly in, making that direct impact? So again, I have to agree with Bruce. You can't get away from, if you're investing, doesn't matter if you're investing in IBM, Google, or Hug Cycles, you are making an impact. Is it a good one? Well, that's questionable. And that kind of gets you into all the political conversations around data, around ESG, what you should be doing, shouldn't be doing, does it affect performance? I think at the end of the day, the more data we have, the more information we have as an investor and someone investing, it can only be for your good. Anyone that wants to reduce the amount of data an investment manager has to make a financial decision on behalf of his clients isn't looking after the end client. It just isn't.
Paul, so you have lots of offerings listed on your website today. What type of returns are you seeing? And are you doing both debt and equity?
We do debt, equity, and we also help our companies also get finance. So that can be for working capital and so forth. The returns, it's like any investment, right? There's pros and cons to all of them. We know as broker dealers, you never know how a company's going to perform. So anyone who's going to tell you, hey, this company's going to do better than that, it doesn't matter if it's a tech company or if it's an agricultural company, there's going to be a lot of areas that impact them. Now, the key element is when you look at any investment is looking at some of the detail that you need. So we talk about Hug Cycles, right? Hug Cycles, revenue $1 million, right? So, okay, you know they've got a business going. They have contracts that they can sign with various government agencies and also a couple of dealerships, actually 400 dealerships across North America. So you look at that and you say, okay, they're a small company, but they do have these contracts, these letters of intent to do it. So is there a risk? Yep, there's still a risk, but you know there's a demand for the product. That's a lot better than going, hey, these guys have a really good idea. They're building motorcycles and basically they feel there may be a marketplace for it. So again, you would go with the one that has the revenue. And that's, again, no different from any decision that's made. Do you buy IBM over Microsoft, right? It's the same sort of process. And again, like I said earlier, it's about data. The more data you have, the more chance you're going to make a good decision. So, you know, Lehman Brothers, right? You could have invested in Lehman Brothers. Everyone thought that was a great idea. And then look what happened to Lehman, right? So, that's
a different discussion. Then we can talk about Bear Stearns.
But what I'm saying is you never know, right? So you
never know. That's
use
true.
as much data as you possibly can. Again, make sure you're using the right people. But the opportunities are there. Don't forget, private equity becomes listed equity. So if you want to
hope so eventually. Right.
Right. So if you want to get in at the beginning, private equity is the place to get in. You know, Tesla, Impossible Foods, SpaceX, these are all private companies that, you know, are now seen as unicorns and billion-dollar companies. They started off very, very small. So again,
absolutely.
It's all about that sort of opportunity.
Yeah, Sherry, I realize that you're powering Rubicon, and that's a little bit different. That's kind of a back-end infrastructure thing, which I think is really cool, by the way. In general, the issuers that you work with, and I'm assuming you're doing both debt and equity, what type of returns do you anticipate? And again, I realize that, first of all, that early stage investments tend to be risky, and that's how capitalism and a market economy works. We need to embrace that. but what do you anticipate going forward? What's your perspective from Rialto Markets?
Yeah, absolutely. So first of all, we are a broker dealer, and we're a FINRA member broker dealer, so we don't really opine on, just as Paul said, we don't really opine on individual securities, whether they're a good investment or not a good investment. I definitely think, though, that we are now in a stage where more and more companies are taking the E and the S, and we're working towards G much more seriously as they create or as they form their companies. And we also have a growing community of investors that are specifically aligning themselves with these companies. So what we've seen is, we've seen many different companies, whether it's EV or whether it's electric scooter, whether it's housing for certain individuals. We're seeing lots of different companies come to fruition that have one of those letters in sort of their mandate. At the end of the day, investors may come in because they have an affinity, but investors stay because they're meeting the milestones and working towards market type of returns. How long that takes, it's a long road. It's a long road from an early stage company all the way to a public company, if the company chooses to go public. So, investors do need to be patient and make sure that they're, investing within limits that make sense for them.
So you would say in general that these securities are competitive with other, non-impact, even though, Paul, you make a good point there that you're creating jobs when you fund these early stage companies. And I think that's a very valid point. But Sherry, you would say that the returns are competitive to the entire ecosystem of private markets, correct?
Well, it depends on the individual issuer, but yes,
Right.
I think those that succeed are having market returns along with the community that they built around them, or at least meeting milestones. Some of these are very long life cycle. If you're building an EV car, it's years. It could be multiple years rather than a different type of business where you're up and running in 6 months and you've got contracts and you've met that milestone. So there are different types of milestones.
Okay, awesome. Bruce, I'm going to jump back to you because you are focused more on debt securities, debentures, effectively munis. Some are regulated, some aren't, which I find kind of interesting coming from a Yankee perspective. What type of returns are these securities generating, I guess, in comparison to comparable debt instruments or similarly risky ventures? I mean, what type of returns can an investor in these products anticipate?
Well, I think it comes back to what we've all been saying here. So it's a portfolio return, i.e. investors should look at a diversification across all the different projects that are there. And then you're looking at a range of risks and returns that sort of suit your need. But our goal is to make sure you understand those risks so that you can build the portfolio that kind of fits your appetite rather than us recommending anything at that point. So I think the range of returns that we've seen have been anything between 6% sort of annually to 12-15% at the higher end risk of venture debt. And obviously some people will have the appetite for that high risk stuff. Others will want to look at our municipal investments where the returns initially were much lower, around 1 to 2%, because we were in a low interest rate environment. Now that's very different. Now we're in sort of 4%, 5% kind of territory. And then I think rather than sort of trying to sort of compare across, because I think these are often unique company opportunities. So you're not looking at, say, a basket of consumer goods companies. What you're looking at is a particular innovator in farming or a particular company that's rolling out EV charging. You're going to look at each one on its merits, and we try and make sure that people got the information to do that. And I think this is the thing around why crowdfunding is actually playing quite a strong role within ESG investing, because it's really just an extension of telling a story about the company. And I think where ESG is running into problems is where actually the process of investing was so complex. if you're investing across public markets and say it's several thousand companies in your universe, you have to simplify that. You have to use sort of quantitative measures and so on to group things. Whereas in crowdfunding, you take one deal at a time. And I think that's really important, that for small investors, I think that's actually, produces better outcomes ultimately, because you're not trying to beat the market. That isn't the narrative that we're pushing out there. What you're trying to do is assess each company and how you feel about them and build a relationship with them. Okay, so completely different sort of mindset to sort of effectively, as someone might phrase it, sort of playing the stock market. And I think this is what we're trying to get away from with ESG, is look at this as a long-term, not just investment, but a long-term outcome. Okay,
so if you were to describe your typical investor, and I don't think you do, you're not doing anything institutional. Are these mission-driven people, effectively?
They generally are. I think there's a proportion who see the benefit of the private markets and having access to them in a way that they have sort of more control on the decision making. They're not in a club, they're not in a fund. But I think yes, we see that. It's interesting. You see that when, say, companies have to change their strategy or change what they're doing, and we've also looked at geothermal, and in that case, we actually didn't follow through to the next stage of the investment because we just didn't feel the risk was right for the investors at that point. They succeeded, but you have to sort of sometimes make the decisions there. But for our investors, they were very keen to stay involved, and some of them then went into the equity that then arrived. So it isn't exclusive to us that those investments will be available. They might pop up elsewhere, as I said, on equity platforms. So I think mission is, I wouldn't say it's quite as strong as that. It's more, these are people who generally care about the future. I don't think they big up what they're doing too much. I think a lot of the motivations are, we see it because a lot of our investors are older investors, quite experienced investors. Grandchildren is a big motivation. And having grandchildren is a fast way to think about your legacy. And I think that, and speaking as someone that might soon be having a grandchild, and I think that, I've seen that it's an interesting transformation, and it's really, we try and sum it up. There's no point saving for a future retirement without a sort of healthy planet to live on it, to enjoy it. And we often paint a picture of retirement around, sort of cruise ships and holidays and other things, but we're not really thinking about the planet that you're having that experience in and what you're doing to achieve that goal personally. So I think they're probably people who feel a little bit more social responsibility when it comes to the impact of their money, and a little bit less individual kind of success motivation around money, if I sort of split that out that way.
Okay, Paul, what about you? What's the typical investor profile on Justly? And I believe you're doing the full stack of U.S. exemptions, which is different from the U.K. Because there's just effectively a funding cap where you have to file disclosure documents. In the U.S., we have all this alphabet soup of confusion for most people. What's the typical type of investor that comes to your platform to back a project or securities offering?
I mean, and I guess because the platform is we use mainly for CF and Reg A. So you're talking about all size investors. You don't have to be an accredited investor to invest in CF and Reg A. CF is up to 5 million raised, Reg A is up to 75 million raised. So you are spending a lot more time on social media. You are reaching out to the smaller investor. In a lot of these cases, you can invest $100 or $500 into these companies, rather than when you're looking at something like a Reg D, where you're looking at the institutional client, the accredited client, which we do speak to a lot. They may be looking at $100, $250, $1 million to start their raise. When it comes to the individual client, I think, Bruce touched on it very well. That I think there's two elements to it. And I think when you start looking at impact investment, what a lot of people will tell you is, oh, it's all done from the heart. It's not about making money. It's not about being a good investment. That's not true. These are good companies. These are good companies coming up with good technology. Tesla, one of the first, what you would class as an ESG company, and everyone raves about them. And they've changed the way that GM and so forth now produce cars, right? There's a lot more of those cars. Well, that had to start somewhere. And Tesla was one of those reasons. So when you start looking at impact investing and ESG investing, this is the new technology. This is the new technology wave that you're looking at, right? Now, you can tag that to certain things, where you can tag it to climate, like we said with Cerify, but that's new technology that's coming in that is beneficial. Not just to the environment, but it's also beneficial because we're running out of oil, right? At some stage, we're going to run out of oil. We need to replace it. So this is just human beings doing what they do and finding new solutions. We've just put a name around it, saying it's impact or it's ESG because we're trying to value it and trying to get another look at it. So these investments that you're seeing, or these companies that you're seeing coming up through crowdfunding, through Reg A, people are looking at them saying, is this the next technology? Is this the next place that we're going? Don't forget, when I grew up, there were no such things as cell phones. And people would have laughed that you would be running around with a cell phone. The only people who had cell phones.
So you're older than 25 then, right?
It would seem that way, right? This was when, Star Trek, it was, you look at all the things that were on Star Trek that we now have, right? But they weren't around in my day. And so when you spoke to someone in that day, it was like, really? I'm not sure if that'll take off. I'm not sure that will take off. There was a belief that computers wouldn't take off. There was a belief that the internet wouldn't take off when it first started. It all starts somewhere, and where that starts, it starts in the private equity market. It starts with crowdfunding. It starts with Reg A. It starts with Reg D. It just happens right now that the technology coming out is about solutions to problems. And those problems are the environment. They are social. They can have that impact. So when the investors are coming in, don't forget the retail investor invests in IBM and Amazon, in Tesla. They invest in these listed companies. So when they're looking at private equity, they're looking at the same thing. They're looking for return. Now, the little difference is there's been more of a spotlight on other elements these companies can do and have an effect apart from making money. And that's
so in a way, supporting innovation and entrepreneurship is supporting impact. I mean, that's kind of what I hear you're saying.
In a lot of cases, yes, because again, we have a vodka company on our list, right? So people are like, oh, well, that's not impact, and it really isn't. Except he's making jobs, right?
Depends on your point of view,
jobs, right? So, and again, one of the reasons we cover that is that we donate 10% of our profit to nonprofits to make sure there is that impact. But my point being is that the element of ESG and impact is just a new name for new technology. And in this sense, what it does have an effect on the environment, because that's where a lot of the technology is looked at, and social. So people investing, again, to make money, you can do it, but they're also now looking at it, again, from what Bruce said, is there a plus to this? Can I make a difference? Like Hug Cycles, can I invest in a veteran-owned business, help them EV, but still make money?
Okay.
Right.
All right.
And that's the.
So I want to keep this moving now because we do have some questions that are popping up in the chat. Sherry, from your point of view, we've talked a lot about green, and there's been some overlap there. What other sectors do you expect to kind of emerge from the impact sector? I think climate everybody gets. When you're talking about social, we've talked about jobs. What other areas do you anticipate will be big? going on down the road in the next 12 months, 24 months, several years?
Yeah, so we're seeing really interesting products being created and offered that really weren't able to be created and offered out to the public or even to different sectors before. So whether it's, and it's really around leveling the playing field and inclusion, sort of the social aspect around that. Because, traditionally, if you think about how a company came to market, they came to market by doing a small friends and family raise, then they went to venture, or they started entering venture, the venture community before going public. Now things are really changing where people are not necessarily going to venture, but availing themselves of other types of funding, whether that be their communities or crowdfunding. So the sectors that we're seeing in this space that are really starting to emerge are interesting areas around, whether it's obviously the climate focus is pretty prevalent, but other areas around being able to level the playing field with different segments of the market. So around housing, around access to other areas, being able to address food deserts, other areas like that are not always top of mind when you talk about ESG, but that are top of mind. And I thought it was really interesting when Bruce was talking about grandchildren. My son, who's 14, is often talking about these issues and is talking about, the 100 companies that are responsible for the emissions of, X amount. So I feel like the younger generation is much more aware because they're inheriting this, and so they're much more aware at a much younger age than certainly I was.
Okay, Bruce, you guys are neck deep in green. Do you anticipate that abundance will move into different verticals? And even if you aren't planning to do that, what other sectors of impact investing do you predict will be big going forward?
Well, we're always looking at how we, I think, help people diversify a bit in terms of different types of investment assets. So I suppose that really comes back to, and this is a new focus in the UK from our regulator, is around what our regulator calls customer outcomes. So it's forcing us to look at the customer in the round, if you like, in the way we think about our investment offer. So we have been thinking about, well, how do we give people that choice that ranges all the way from sort of listed funds through to crowdfunding through a single portal, and can we do that? I think that it's really driven, I suppose, actually, more from our customers. So we sort of review that every 2 to 3 years to make sure we're covering, because you've got to go through a process of due diligence and exploration into a market sector if you're going to new. And as Paul said, a lot of this is new technology. There's a lot of things to sort of consider and learn about. So we sort of set strategic sectors, and we've been sort of plowing those furrows for the last 2 or 3 years. So we're about to review that again. And a lot of what drives that actually is government policy, because we're talking about the environment, about green. And I think that the IRA Act is a bit of a game changer in terms of sort of opening the doors that governments are now actually going to start driving these markets. And I think that will obviously have good and bad effects as ever, but it will mean that there, I think, will be more choice and more companies coming through. That's what we're seeing. So I think the thing that's perhaps held back green investment in our market has been a little bit stop-start in terms of those companies coming through. So you haven't always had the choice there that we would have liked. And it is, you do need that momentum, because you do want people to be spreading their money as wide as possible. And I think what I'm hopeful is that we've now sort of reached a bit of a tipping point in terms of the sort of pace of deals that are coming through. So that's the sort of so from our perspective, I think the future is going to be quite a lot of change, regulatory driven, that's going to shake out a lot of the funds that we're offering what might be described as ESG investments. But on the other side of the equation, on the sort of private market side, a real acceleration in terms of the range and scope of deals that are there. And you're talking about sort of alphabet soup. I think we're just going through a bit of a change in the UK market in terms of the regulation of crowdfunding, and we're going to see hopefully see a permission that's going to be a lot more, what sounds like a lot more like a Reg A offer structure alongside the crowdfunding structure. And that's sort of reflecting the fact that actually there's a need now for these green businesses to get scale up funding. And I think that so we're sort of shifting a little bit, and Abundance may move with that, is towards larger scale raises for much larger scale projects. And that's a sort of natural evolution probably in some of these markets. EV is a good example of that. So we've just funded 2 EV companies, hopefully another one, where we've put in around sort of 8 to 10 million, and then they've gone on to raise 100 million. Now, I would really much like to crowdfunding to do the 100 million part as well as the 8 million, but we got them on their way. We can.
You're getting there. Yeah. Mm-hmm. So I want to keep this moving because we do have some questions I want to get to. So in the United States, ESG has become a bit of a polarizing topic, and it largely has to do with whether or not the government should be mandating this, not the impact. The impact stuff is fine. It's more about government control. And I'm going to go to you, Paul, about this. Jamie Dimon, in his annual letter, which is closely followed within financial services, he stated within that letter, with intensified public reporting, investors' growing needs for environment, social, and governance information, and the universal proxy, which makes it very easy to put disruptive directors on the board, the pressure to become a private company will rise, meaning fewer public companies. Corporate governance principles are becoming more and more templated and formulaic, which is a negative trend. For example, sometimes proxy advisors automatically judge board members unfavorably if they have been on the board a long time with a fair assessment. And he goes on effectively saying he's pushing back on mandates. At the same time, JPM is huge into impact offerings with their funds and mm-hmm. whatever. I get where you're coming from, Bruce. Paul, what do you think about this?
I think we touched on it earlier, and companies don't like more rules. They don't want more governance, right? And we saw that recently, right? If you look at the last government, they took away some of the banking rules, and then we had a bank go down, right? So the marketplace, the companies don't want rules around them. So they're always, in most cases, going to push back, right? Because it costs money. And we touched on that earlier. It costs money. You got to put more compliance in, more legal in. They just don't want to be judged more. And he's right. A lot of companies will go private or could go private. Some companies, you look at people like Fidelity. Fidelity is private, right? Some of the biggest companies are private. And the reason they're private is there's less governance around them, so to speak. So I think you're going to have that pushback. I think where it changes is that the investor has to speak, right? It's really down to the investor. And if the investors are saying, hey, we want this information, and you're not doing this, and we're going to start judging you by it. And if you're not giving it to us, then we will vote with our feet and vote. We will go to JP Morgan instead of going to Goldman Sachs, or we'll go to this company instead of that company, because they are doing governance. They are showing the impact that they have on the business. So I think it will come down to the individual investors, and it will come down to the institutional investor, which makes life even more interesting. Because if you look at the institutional investor, when we class an institutional investor as a Fidelity, as a BlackRock, but they're actually managing individual people's money. So it still comes back to the individuals. So the individuals, again, will be asking these funds to give them information around who they invest in, why they invest in, what data are they using, and are they impactful? And so you will start seeing more and more of those questions come from investors. Now, what you have seen is that pushback in ESG. But what's happened is people are saying, hey, yeah, we got to push back in ESG, but we're doing impact. They're one and the same, except impact has more data around it. So it's just a slight change on words, but I would say the individual investor will have its say, and they will be pushing more and more to have more transparency on how these clients run their business, these companies run their businesses around certain data that's linked to ESG.
Okay, Sherry, quickly, since you worked at Goldman, you worked at Deutsche Bank, what's your opinion, your spin on this?
Absolutely. So I think definitely there is a push for more data and other types of frameworks around ESG for public companies. And the Chairman Gensler, who's the SEC chairman, both when he was testifying before Congress yesterday and also in his annual letter, really said, the SEC is not a merit, they're merit neutral. So the SEC is not going to say this industry's good, this investment's good. They're going to be merit neutral. However, he also stated that they have an important responsibility to the public around public companies' full and fair and really truthful disclosure. So I could see him sort of setting up there the responsibility for public companies to report more data, to Paul's point, on ESG topics. This will make being a public company potentially more expensive and might lead companies to move into the private sector. But I do think that overall, individuals will then start looking at some of these metrics and being able to analyze them as appropriate.
Okay. All right. So we're running short on time here. I'm going to jump to the questions right now. I'm going to try to get through several of these. We're going to start with one for Paul. Justly Markets is focused on supporting small businesses and communities that are traditionally underserved by mainstream financial institutions. How do you ensure that these businesses meet ESG criteria and have positive impact on their communities? Please give a brief answer.
Yes. So we do the normal DD that any investment bank would do on any size of private equity company. So we look into them. We do checks on the ownership. We also introduce them to a company called Proof, used to be called Proof of Impact. This is an organization that will actually evaluate the company on the type of impact that they're making today around E, S, and G. So we do some legwork around that. We do some good DD around them to make sure they're a legitimate company and are following what they say they're following.
Okay, Sherry, thank you for that. Well, Sherry, what role do you see Rialto Markets playing in the future of ESG and impact investing? And how do you think the industry will evolve in the coming years? Are there any specific trends or technologies that you believe will have a significant impact on the way investors approach ESG and impact investing?
So I definitely think from an EV perspective, we're going to continue to see developments in the EV space. Also in food and agriculture, that type of technology will begin to see more evolution there. And we are seeing different companies come to us from those spaces that are looking to raise initial capital, and then as they need that scale capital that Bruce spoke to really further the impact. So that's where a couple of areas that I see it, firsthand from the companies coming to us.
Okay, this one's for Bruce. Perhaps most companies that will have a major emissions mitigating impact are industrial, okay, B2B companies without large stakeholder groups to tap for crowdfund campaigns, especially if they're tech firms with no or little minimal Twitter feed or social presence. What advice would you give to a company that's looking to raise capital online that is more, industrial focused, B2B, that's in the space?
Interestingly, most of our clients fit exactly that. Someone who runs a wind turbine isn't a social media whiz. And so, yeah, we've done everything from pipeline, gas, hydrogen pipeline manufacturers, these sort of things. So unlike in equity crowdfunding, where yes, a lot of the work has to be done by the companies and their community, on the debt financing side, we've made it more our business to do that work and be paid to do that work. So in terms of our own business model, our raised fee is really about giving those companies the ability to market their offer to that audience, and not simply providing a conduit to that audience. And that does differentiate us a little bit from the equity side, because we're raising those larger sums. So I think, and that's always been our model, and it's always been something of a challenge for us in the way that the regulations work relative to the equity crowdfunding side. So it's yeah. So it is actually, that's my role. My role is to market these products. So yeah, you're paying me to do it.
Awesome. So I have another question for you, Bruce, because I think this is a good one. So Abundance has a strong focus on renewable energy and other sustainable infrastructure projects. What impacts have these investments had on the transition to a low carbon economy? Can you put a number to this? Can you measure this and say it was this amount? Is it just a guess? Do you have an idea what you've done it over the years?
Yeah, we've always, because I could say there's a number of megawatt hours, and sometimes we add those up. My pension, I drive past the wind turbine that's in my pension every day. So it is, people look at the impact much more. I think initially they saw it in terms of that sort of megawatt hours generation side. If we're backing the future of the UK tidal industry, which is then the global industry, you can't really measure it in that way. And what people want then is the stories and the people, and to know they're helping make something happen. Okay, so they're not measuring it in quantitative terms, it's qualitative. And I think that kind of comes back to that motivation. It's very personal, it's very much a connection to your money doing something. That's the essence of impact. If you start to try and measure it, if I'm honest, you take a lot of the fun out of it. You actually take the interest out of it, because you're kind of then saying that, for me, is
you're
what
removing
you do
the magic.
Massive portfolio, and you're trying to work out, have I optimized it? Whereas at an individual deal level, it's, have they done what they said they were going to do? Have they achieved it? Has things moved more quickly? Have I made a difference?
Okay. Paul Jean is asking, are you seeing Reg CF offerings being used for greenhouse development? I think that's a little bit narrow, but what are you seeing?
Actually, we have.
Reg CF, what type of offerings? Okay.
So we're actually speaking to someone right now who's actually doing greenhouses.
Okay.
And it's about producing better vegetables, cleaner vegetables, and getting them to market quicker. So they're able to produce these, and this isn't, when we talk about greenhouses, right? We normally think of the small one that you have in your backyard. These are over acres of land, and so they're able to produce lettuces and so forth. A lot of this done right now is being done in New Hampshire. There's 2 or 3 companies that are doing this, and they're able to produce that locally and deliver locally. So you're now not just being able to produce the vegetables in a quicker and easier way, and more the delivery is easier because it's a lot closer. So yes, you are.
That's a big business. I mean, I see that when I go to the grocery store. I buy that product. I like it.
Mm-hmm. Yeah, it's, as I say, and it's being done in such a way, but it's technology again, right? It's this new technology they're bringing in that can produce these vegetables a lot cleaner and more efficiently.
Awesome. So last question. We're going to give this one to Sherry. Can you elaborate how Rialto Markets' partnership with Rubicon Carbon supports ESG and impact investing objectives, and what specific environmental social benefits partnerships seeks to achieve? Maybe you can give some more details as to what type of impact this is having. Maybe it's too early because it was only announced, in the past few months. I was going to say, what do you say?
It's a little early. It's a little early. Right now, there's about 300 million in carbon-based offsets set aside for these investments. So, really the impact is very, very early days. I think we just announced it a couple months ago, but we will know, closer to the end of the year, some of the uptake and impact from the corporate perspective.
Okay, awesome. So I'm going to give everybody a chance to do a final word. Sherry, what are your expectations for 2023 in impact investing and beyond? Very quickly.
I think we're going to continue to see people, communities come together to really help support businesses that are in the impact space, because it's becoming more and more top of the priority list. Whereas maybe 20 years ago, you could kind of look the other way. It's becoming real at this point for people.
Bruce, OG Bruce, 2023 and beyond, what do you anticipate?
In the UK market, I'm hoping that we get this scale up, that we move to the next level. Another bigger deals, larger companies, because actually that's where the opportunity now is, and crowdfunding stepping up to do that and being seen as the right vehicle to do that, and competing with other sources of finance like funds and so on.
Awesome. Paul, what are your predictions?
I'm excited. I think it's going to continue to grow. And I think the reason it'll continue to grow is people will understand it better, right? There's going to be more data, more ways of looking at it, and it will become more mainstream and less divisive as it is today. So I think over the next 6, 12, 18 months, you will see impact investing continue to grow, more good technology, and a better understanding of what it truly means.
Awesome. Okay, so we are out of time once again. First of all, I want to thank everybody who has attended this session today. I want to thank Bruce at Abundance, Sherry, Rialto Markets, and Paul Justly for sharing your knowledge and your expertise. I also want to thank our two main sponsors for this series, Dalmore and Dealmaker. These guys both offer full stack of securities exemptions to private issuers. They're awesome. And I also want to remind everybody to register for our next session, which will be on the 17th of May. We're going to discuss safeguarding your investment. This is an important topic because, as we know, private securities have risks, just like every other investment. So thank you, everybody, for participating today. It was great seeing you, Sherry. Great seeing you, Paul. And great seeing you, Bruce. Once again, we need to do this more often. So thank you very much. Take care, everybody.
Excellent.
Thanks so
Thank
much.
you, Andrew.
Have a great day.
Thanks.
Thank you.